And welcome. It's Mary Ellen McGonagle here with your Friday afternoon MEM Edge show, the show where we bring you where the action is in the broader markets. And we did have certainly a very, very tough week last week. We are going to talk about why what took place did as far as the pullback and when is it safe to wade back into these markets. We are going to be using historical precedent. I'll also be sharing with you the best place to begin your watch list and where to search for those names that will go on to outperform. So let's go ahead and start with those news items. Certainly front and center was the fact that the Federal Reserve announced that they are lowering or reducing the number of their rate cuts next year to 2. And that really did shock quite a number of people, traders and investors. And from there, we did see the yield on that 10-year treasury rise. So I will share with you where we closed for the week with that and the impact it has had on the markets. Also, we did get news last week that Q3 GDP numbers came in rather strong, and also economists are revising upward their estimates for this quarter. So we are continuing to see strong economic growth. But good news today on the inflation front, and that is that core PCE data, and this is data that the Federal Reserve closely watches because it excludes food and energy, and it is more of a direct monitor of prices, and we did see a decline, and the markets did find that encouraging. We did see a relief rally today, but was it enough? We will get into all of that and more next week. Holiday shortened week, of course, and we will have some economic data, but nothing as impactful as this week. We're going to see consumer confidence, durable goods numbers, and then also weekly jobless claims. So let's go ahead and get started. Take a look at these markets and see where did we close for the week. And here we are, a daily price chart of the S&P 500. And we did see this is that decision on Wednesday. The markets did pull back sharply, and we did see a little bit of a continuation selling on Thursday, and then that relief rally today centered around those PCE data numbers. Now, we did close just at this 50-day simple moving average, which is currently sitting at 5927, and we closed at 5930. So just a hair above that key 50-day simple moving average. You can see that the RSI, that's that relative strength indicator, still in negative territory, and the MACD is still up here in positive territory. So a little bit mixed on that momentum. But again, as we move through today's show, we are going to take a look at a most recent historical precedent relative to the markets pulling back in a rising interest rate environment. So from here, let's go ahead and take a look at the S&P 500 sectors, those 11 sectors. What you want to stay on top of is where that relative outperformance is. Where is that strength? We will be getting more into this because you want to be aware of that. History or historical precedent tells us that in a period when the markets pull back, those areas that are able to withstand weakness elsewhere, once those market pressures lift, they will go on to lead the markets higher. We don't have a lot of information here. We are 2 days beyond the Federal Reserve's announcement, but it's certainly enough to get us started. So let's go ahead and take a look. I did sort these 11 sectors by that relative strength indicator in descending order. We're looking at a 2-month daily price chart view. So let's take a look. Quite clearly up here at the forefront, we have consumer discretionary, technology, and communication services. Now, these are your growth areas of the market, and they are still sitting up here at the forefront. So strength in growth, which has been a theme over the last several weeks. And then as we move through, taking a look in this lower right quartile, these are your weaker areas. Make sure you're not overweighted, but they are actually your smaller areas as well. So we have REIT stocks, basic materials, energy and healthcare still struggling, industrial stocks and staples all below their key 50-day simple moving average as are utilities. Now, this is something I pointed out in my MEM Edge report last Sunday. The fact that the majority of the S&P 500 sectors were trading below their key 50-day simple moving average. Breadth was very narrow. I did not add new buy ideas to the list because the markets were not accommodating and were not looking constructive based on the breadth being very, very thin and other characteristics as well. So if we take a look this week, you will see, for instance, with technology, we did pull back below that key 50-day simple moving average, sitting there at about 233.3, and we did close at 234. So just right up above that 50-day simple moving average, but just an awful lot of volatility throughout the last half of the week. Now, beyond these sectors, we do want to get a little more refined as far as sub-industry groupings to get a better feel for where strength is emanating in the markets. It's all relative. Again, a 2-month daily price chart view, and let's take a look up here at the forefront. I talked about yields on the rise. We do have this yield on that 10-year treasury sitting here at 4.5%. Now, historical precedent tells us that that 4.5% level in the 10-year yield historically does bring volatility to the markets. And we did, in fact, see that last Wednesday and on beyond. Also, let's take a look here at volatility. It really spiked. This is Wednesday's big spike up to 27.5. I did talk about this in my midweek report that oftentimes when you see a spike in volatility, you will in fact see a buying opportunity, and that would be today's rally. With that move, you can see volatility is back down here at 18. So that is certainly of note as well. And then moving through these industry groups, let's take a look at software stocks. They were the leading area for quite some time, hitting a new high here at the beginning of this month, but falling back pretty dramatically, but certainly in line with other areas. Now, software stocks do not fare well generally in a rising interest rate environment. However, the group is still above this key 50-day simple moving average, and there are about 350 software names, and there are definite pockets of strength. Hopefully, we'll be able to cover a couple of those names. Certainly, one comes to mind as the leader in this space. But let's go ahead and move through and take a look at some of these other sub-industry groupings. Retail held in fairly well. It was down less than 2%, just a little bit more than the broader markets. You can see this pullback very sharply on Wednesday, followed by back and fill price action. Net retailers are holding in really well. Now, semiconductor stocks are cyclical. It is a very mixed group, and we did end back below each of these key moving averages with the momentum indicators now in negative territory. Also, moving through with these industry groups, I do want to share with you some other areas that got hit rather hard. IHI is the medical products. It's the growth area of healthcare. You can see that we pulled back sharply, but more than anything is just a lot of volatility with negative RSI and a negative MACD. Healthcare overall has really struggled quite a bit, but when we talk about economically sensitive areas, we need only look at banking stocks. This is KRE, the regional banking ETF, and the group was down 6%. And this would be certainly an economically sensitive area of the markets. When you talk about high inflation, you are going to have that fear creep in as far as possible slowdown, and economically sensitive areas are hit the hardest. Biotechs in that rising interest rate environment, and also an area of the markets that is risk adverse, very sharp pullback and a continuation of that decline. Also, small cap stocks, they were down 4.5% last week. Another area that is not going to fare well in a rising rate environment. A lot of these smaller companies need to raise capital, and they will be much more sensitive to a rising interest or loan rate. Also, one of the hardest hit areas, housing, very cyclical and very, very tuned into that interest rate environment. You can see this is XHB, that home builders ETF down over 7%. So a very swift decline there. So for those of you that are looking at the markets at this time, I am going to share with you, I talked about using historical precedent as your guide. This is something that I shared in my midweek MEM Edge report. And it is using historical precedent from earlier this year. So in the beginning of April, we did see interest rates rise. Now, the reason for that is because inflation numbers were coming in strong. That 10-year got as high as 5.7% back there in April. We also saw volatility. It didn't spike as we saw last week, but it certainly did rise. This is all about fear. If you were to go back and take a look at some of those headline news from the beginning of April, there was an awful lot of fear in the markets as inflation was increasing. We did see rates rise, and then we did see a pronounced pullback in the broader markets. This bar chart with the coloring is the S&P 500, and then the thin line is that yield on the 10-year. So you can see as interest rates spike, markets did in fact pull back. When the rates did begin to decline, we did see the markets regain their footing. So let's take a look at where we are now at 4.5% on that 10-year yield. And we did have the markets beginning to pull back. Now, there's going to be quite a number of other factors at play here, but this is, again, using historical precedent. Let's go ahead and take a look at the S&P 500 in that April period and what the qualifications or characteristics were when the markets did recover from that pullback. So here we are with the S&P 500, that April pullback in the markets, and a couple of the key characteristics that denoted that the downtrend had reversed. First up, we did get what's called a double bottom. That's when your market pulls back. We have a rally, it pulls back again, but that low is at a higher level. So that's your double bottom formation. And then let's take a look at this momentum. We had that RSI enter back into positive territory. The price of the S&P 500 closed back above this 50-day simple moving average. And then we did have that nice MACD crossover, black line up through the red, signaling a new uptrend. And so we did go ahead and have a significant rally into mid-July. So let's take a look at the markets. This is, again, a current view. And you can see that, as mentioned in the beginning here, that the S&P closed just at its 50-day simple moving average. So that is going to be one of the characteristics to keep an eye on. Also, keeping an eye on this RSI, we want to get that back above 50, and likewise with that MACD crossover. So using the S&P 500 and historical precedents as your guide, we are not quite there yet as it relates to a new uptrend in the S&P 500. Does not mean it's not time to begin looking for new candidates. And last week I showed you how to look at the NASDAQ 100 and sort it by relative strength so you can really remain on top of where that relative outperformance is as an area to begin putting your watch list together. So this week we are going to do the same exercise using the S&P 500, but I do want to show you how to do it. I failed to do that, and a couple of people had asked, how do you get to that? First up, you will need to have a subscription to stockcharts.com. But from here, it is really quite simple. You go over to this ChartList tab here, and then hit new. You're going to be creating a new list. Give that list a name. Now, in this case, I'm going to be using the S&P 500 as a for instance. You can create your list and use a name that would speak to you. And from here, once you've named your list, you can go ahead down to this add symbols button, and really quite simply, you can pull from any number of predefined list that are here on stockcharts.com. So for instance, the Dow, the S&P, the NASDAQ, and so on. Last week, we did cover that NASDAQ 100. Today, we are going to take a look at that S&P 500. It's going to be a broader grouping. So add charts. And once you've done that, you can view this list in any number of different variations. I'm going to go ahead and use that 2-month candle glance view, again, sorting it by that RSI. This is another variable that you can sort it whatever speaks to you here. And on descending order, update the list. And what I did want to share with you when looking at the S&P 500, it is sorted by relative strength. At this point in time, Boeing is up there front and center after being very down and out due to their news as far as putting a lot of capital toward the creation or manufacturing of their Dreamliner airlines. But let's go ahead and take a look at some of these other names up here at the forefront. These are your relative outperformers, and I do have a list of other names called What Pullback, and these are going to be primarily names that really didn't get oversold or pull back sharply. Apple certainly among them. Here we are with that Wednesday pullback in the markets, modest compared to what we saw elsewhere, pulled back very orderly to this 10-day simple moving average. And then from here, we did have that nice rally today. So setting up there really quite nicely. Talked about a leadership name in software, and far and away, it is going to be Palantir, PLTR. This is a name that has been on the MEM suggested holdings list for quite some time. And also another name on Wednesday that pulled back very modestly compared to its peers. The reason that this is significant is because that buyers supported the market, supported this particular stock in a weak market environment, and that indicates investors want in. And sure enough, today with that relief rally up 8.5%. So moving through, taking a look at some of these other, I did want to point out another theme, because when you see themes shaping up, and by that, I mean that you see a number of stocks in a particular sector up here at the forefront exhibiting strength, there are sound reasons for that. Oftentimes, it is going to be an industry group that is experiencing growth. We are finishing up with earnings season. So from here, I will share with you a couple of these names. DRI just reported. This is Darden Restaurants, a restaurant company, of course, that gapped up into a base breakout, super high volume. And then as we move through these names that are up here at the forefront exhibiting superior relative strength, you will see other retailers. Deckers is up here, of course, their Hoka sneaker, UGG boots, also TPR, leather, handgoods, handbags and such, Tapestry sitting up there, Ulta. So really what I am pointing out to you is the fact that we are seeing a pretty good strength and showing here of consumer discretionary. The cruise line, CCL and RCL, had a nice recovery rally today. And then also as we move through, Ulta Beauty and Lululemon. This is a name that I talked about last week as far as potential buying on any pullback. So thematically, we are seeing, again, vibrancy in this consumer discretionary area. When you see a stock, for instance, such as Visa, it's going to tell you that consumer spending is still very much in place. And it also, in my mind, is going to be consumer driven, even though it is a financial stock. Dollar Tree, eBay, RL, and so on. In fact, eBay is sitting up here really quite nicely, forming the right side of a base. Nice high volume today and nice uptick there in that momentum. Ralph Lauren and so forth, without getting too into the weeds, but Kroger, Amazon. So a lot going on as it relates to consumer and the strength that is still being displayed in that area. So that is what we are seeing up here at the forefront, likewise with some of these airline stocks. So again, this view of any given index, whether it is a sector or a broader index, you can very quickly assess where the strength is emanating. Those areas that are sitting up here at the forefront on that relative strength scale. So from here, I was going to also share with you some other names that did exhibit outperformance last week, did not pull back as sharply as others, again, for that watch list. So here we are with Reddit RDDT, recently public company that pulled back modestly to its 21-day simple moving average, sitting up there quite nicely. We talked about Palantir. Let's take a look at Netgear, NTGR. This is a name on Wednesday that actually had gapped up and then pulled back a little bit on Thursday, but here we are back in play here. Another name, we did already look at Apple. Let's take a look at Ciena, CIEN. This is a networking name, and it did have that gap up. Again, we talked about growth being the driver, and this was on earnings. The stock is now in a base building period following that gap up on earnings. And then another name that I mentioned in the past, REAL. This is a name that I picked up for my PA. They did have, in fact, back here on that downtrend reversal. But let's take a look at last week's price action here in the stock. This was on a Wells Fargo upgrade. It gapped up into this base building period, and the stock very orderly pulled back to its 10-day simple moving average. It is a small cap apparel retailer, so in that stronger area that we were talking about. And then today recovered that 10-day simple moving average, so sitting up there quite nicely. Last up is a name that we talked about last week as well, Urban Outfitters, URBN, very orderly pullback, and then a recovery rally today, sitting up here quite nicely. And so to recap, the broader S&P 500 still does have work to do before getting back into an uptrend. We're going to be keeping a close eye on interest rates as that guide. Also, we did see volatility get back down to that 18 level, which is really quite good. Ideally, 16 or below would give a better sense that the fear has really left the markets. We're not quite there yet. So just a little more work, but net, keep an eye on those longer term views of the broader market indices. This is something I talk about in my report because for longer term buy and hold investors, you don't want to be distracted by pullbacks that are not going to impact the longer term. I'll be talking about that in my report over the weekend further. So go ahead and use that link below to trial my twice weekly MEM Edge report. If you like what you've seen, go ahead and hit that like button as well. Everyone have a great holiday week. I'll see you here next Friday.